Of course, any kind of investment process starts with sourcing. A point about sourcing is that these investment companies typically go through something like 2,000 to 3,000 companies a year, if not more. So they only invest in a handful. So of course, a very selective process where only a few are picked. And so in this process, a lot of the more junior staff in the VC funds will operate. So make sure you become friends with the investment managers and the associates. You don't have to go directly to the partners. Those guys are your gate and your ticket to the investment committee. Then it goes into a diligence phase. In the due diligence phase, it is a lot of deep diving into your product, into your growth, into seeing, differentiators, etc. And this is a process that could take 2 to 3 months in the short term, or even 6 months or longer in the long term. So you can really get in touch with VC funds way before you need that capital and start that process early. And of course, then everyone's happy, you get an investment, you think that's it. It's not at all, in fact. That's when the real work starts. It's a fact that back in the day, 10 years ago or so, 2 to maybe 4 years it took for an average company to have an exit. Now that's 5 to 7 years. So it's harder than ever to exit the business. And it's very important that when you team up with a VC, that you really like those guys, because you're going to be married with them for a long time. So make sure it's someone you really like to work with. As for strategic M&A, we're not going to talk about that. It's another way of growing. And in the end, you move towards an exit. 3 real ways to exit, of course, as you know: an IPO, a financial sale, and a strategic sale. Now, as I said, harder than ever to do this. The VC funds are thinking about this from day one. So when you're speaking to them and when you're pitching, have this in mind about what's the potential exit scenarios, and is there any M&A activity in the space that you can refer to in your pitch. Okay, so that's like generally the cycle. We're going to talk about how we source. How do we find investment so that you can be at the right spot at the right time to secure capital? The first one is, of course, inbound. We really love receiving potential new prospects from you guys. So even though some people might tell you, oh, you don't need to, basically, you can reach out with cold emails, don't worry about that. Most VC funds appreciate receiving emails with your pitch, even though you don't have a referral. So it's perfectly fine to reach out directly. Just make sure you educate yourself a little bit on the sector, stage, and geography that the VC fund is focused on. So when you raise capital from those guys, or when you reach out rather, you know what funds to speak to. But inbound is very much appreciated, and please start doing it before you need capital, so you're not in a bad position to negotiate and so on and so forth. Events like this, another great way to build inbound and outbound, right? So events is really a good way to meet one-on-one, to have meet a lot of people like this if you're speaking, or you're in these fireside chats, or even judging pitching competitions, and also a great opportunity to go out and get drunk together, which is a perfect way to really connect with entrepreneurs and become friends outside of just business. All right, referrals. This is just like the inbounds, just that you know someone. It could be another portfolio company, one of your friends, right, that knows a VC fund. It could be advisors. It could be other VC funds. You're going to be anything that can give you a warm intro. Of course, if you can, that is better than just a cold intro. Universities is another way we go. So if you're a university student, you have a TTO, a technology transfer office at your university, use that to get in touch with investors. We actually team up with several of the top universities in Northern Europe in order to meet companies early. One of the best investments at my previous fund, Nata Capital, was found through a university. Was an e-voting business called Cytle. And of course, it's huge risk investing in companies that are that early. But of course, those companies, if they're successful, the valuation uplift will be huge. So it's quite exciting getting early if you hit it right. And last but not least, outbound. Of course, we also, even the top funds out there, sit and search, go through databases, and really try to find you guys before the other funds do. Of course, there is a bit of competition out there. So outbound is something we still do, and we are excited when we can create those relationships early, even before you need to raise capital. So that's just a little bit about how we find deals. Now we're going to talk about something else. What do we look for? And this, guys, please, as we walk through this, think about your pitch deck, about what you put in the pitch when you're speaking to VCs and in your slides. So the first one is a bit of a cliche now, but it doesn't make it any less a fact. The team is incredibly important. It's actually been mentioned just in the fireside chat and throughout this conference so far that being an entrepreneur is very, very hard. So that means that it requires an ability to deal with doubt, extreme doubt, even from your close ones sometimes, insecurity, people questioning what you do, failure throughout. It's kind of self-torturous. And there isn't a lot of people that want to harm themselves that much. But, some people do because they're so passionate about what they're building. And that's the kind of people we're trying to find. So to get across that kind of mentality is good. This is a whole session in and of itself, by the way. And this is a lot about previous experience working with entrepreneurs. And it's more of a psychology thing than a metric-based thing. Okay, like we spoke about, stage and sector and geography. This is just kind of educating yourself a little bit about what the VC fund focuses on. We're focused more on B2B than B2C. We look at companies that are typically raising between 2 and 10 million euros. We're a little later stage, but we prefer to also make relationships earlier than that. And we focus mainly on Europe, but we look opportunistically outside as well. Just do your research before you reach out. Disruption. Okay, so quite the buzzword there, but disruption is a way for you to generate real impact. We all know, or maybe as many of us know, that most businesses fail because there wasn't a big enough need for what was created. Is there a real need for what you built? And that is something you have to get through in your investment presentation. This is something that our customers really, really need, and disruption is a way to capture that. If you really change a market as a whole or processes within businesses, then you're making real impact. An example is a business we invested in called Be My Eye, which is a market intelligence company. Back in the day, Nielsen used to do market research, took really a long time and was really costly. And they were doing things like mystery shopping, price checking, different kinds of promotion control, and all of those things were heavy and expensive processes. Now, what Be My Eye did was say, hey, let's use the power of the crowd instead. So they created an app with a bunch of jobs that, for instance, Coca-Cola could post, and people like you and I could run around, take pictures of the prices, use their smartphone to do this kind of market checking. And within just a matter of a few hours, Coca-Cola, which was a customer, would have thousands of data points at a fraction of the cost of what they had before. An example of utilizing technology in order to really disrupt a segment that hasn't seen the impact of technology to date. And this is something that we look for in the companies we invest in, and something that a lot of VC funds will also be focused on. So this has been talked about today, growth, right? Another super important thing to get across when you are speaking to the VCs is that your company has real big ambitions and can grow really fast and can get there fast. Why is that so important for VCs? It's not that important necessarily for angel investors and private investors, right? But for VCs it is, because they have a portfolio where probably something like 20% of the investments will stand for 80% of the returns. So since several of these investments unfortunately doesn't make it, the few that does really has to make up for the ones that don't. So in this case, you really want to try to convince them of this fast and steep growth and the huge market that you're going after. And I also want to mention here, guys, that it's perfectly fine if your business isn't a venture backable business. If it doesn't have that global, billion-dollar potential within 5 years, completely fine. But, if you're going to go out there and raise VC money, you have to convince them of this particular point. The next thing here is another thing that really goes into your investment presentation. And I'm going to talk about two things: differentiation and barriers to entry. How is your winning product really different, and even on a feature level, from the kind of products that are already out there? And I'm not talking about just Turkey. I'm talking about how does the landscape look in Europe? How does it look in the US? And compare yourself to those guys so that the VC will believe that when you're doing your international expansion, you are going to beat those other guys that are out there. And how are you going to do that? And you will deliver that message in that pitch so that the investors stand there and say, wow, this business, I'm going to get really wealthy and it's going to return my fund on that particular investment. So how are you protected against new entries and how are you differentiated is a very important point to VCs. Timing is the next thing. We all know this is a bit of luck, right? But timing is really two things. Timing is one about, is your product ready to go to the market? And here's like the typical two problems that you can have. Either you go too soon, and I've seen this with investments we have in the past, and it's just been not ready from a product standpoint, and it's broken the trust from its potential customers, and the new prospects kind of testing it out. And the other problem is if you go too late and you have the engineering problem. I'm a computer scientist by education, and I love to sit and tweak and make it perfect. Maybe you lose your window. That's not the right way to go either. So that's if your product is ready for the market. Another big thing is the market ready for your product? Here's more luck involved, right? I mean, you just see Google scrapping most of their VR plans now, for instance, and just taking it back to research. Of course, this is because consumers weren't ready to adopt it yet. So even the big companies can't hit this right. So this is very tricky. And actually, I remember once I was an intern at a VC fund many years ago, we invested in a smartphone that flopped. It was before the iPhone, and it was a really cool product, but people didn't really get it. And of course, we didn't have Apple's marketing budget either. But, it's an example of how timing is tough to hit. All right, sustainability. So we talk a lot about sustainability today and in society these days, but another form of, so it's not just social sustainability, another form of sustainability that investors care about is, of course, financial sustainability. What is your revenue model? That is another thing that absolutely should be in your VC pitch deck. And the question is your unit economics and how you're making money. In B2C, it's often advertising based, in-app purchases, it might be commissions or premium models. In B2B, it's usually subscription based. Now talk about a capital efficient and a smart and sustainable business model and revenue model, a subscription based, right? That's pretty amazing. Back in the day, you sold software on a one-off basis. This is a very tricky model because when you don't get another customer, you have zero revenue. With, of course, subscriptions, you have it into perpetuity. And what investors really like about this, beyond like the safety around that, is of course the ability to judge your pipeline and how the future revenues are going to look. So this one is important to get across in the meeting as well. Scalability just goes back to the point around growth. It is the aspect that your gross profit margins, for instance, tells the story that your company with not that much capital can become a huge international success. How much does it cost to scale it? Not that much. You're going to get really far with little capital, which is why it ties into the last point on capital efficiency, which is another word you should also mention and talk about. Investors will look on your previous capital efficiency. They will say, you spent this much money getting where you are today. Okay, well, it will cost you this much to get to your next stage. So make sure it's not a good thing to say you spent enormous amounts of money building your product. You really want to balance that with giving the feeling that you can get really far with the money that the investors are going to put in now. So that's just a little bit of a quite high-end view of how we look at things. I want to mention also, we're not going to spend a lot of time on this, but when you reach out to a VC, it's not just about the capital that they can put in. Of course, it's also about other type of value that they can add. And there's so many new investors out there now. Last year in London, there were 30 new VC funds that came up. 30 new VC funds in London. That's crazy. That's everything from, smaller seed funds and up, and many of them are probably not going to finish their complete race, but there's a lot of capital, and these people want to bring value above and beyond just the money. So how we try to help is a few things. Recruiting is one, trying to bring, the pool of talent that we know from before to help you build the right culture. We know culture is very important. Credibility, opening the doors to new potential customers, suppliers, etc. Really being that door opener, helping you guys with that without getting in the way of your operations is important. And, around financing and operations, these are other two things we try to help with. Again, not getting in the way of your day-to-day management, but to bring advice and high-level strategy where we can. On the financing piece, though, we in particular actually spend a lot of time because, as I said, we only invest a minority stake in that between 2 to 10 million round, and we always work to bring in our friends from the leading VC funds around mainly Europe and the US, at this point at least, to complete the round and to give you guys a base of really, really strong and leading international investors in there. And last but not least, international expansion and all the above, really, when you're doing that, is something we're quite specialized in and several of our team has done before.